We're here to empower high-income earners to gain back control of your time through financial independence and stop trading your time for money and start letting your money work harder for you.
And hey, if you want to meet other high-income earners on their FIRE journey, join our High Income Earners FIRE Facebook group. Every month, we'll have guest speakers and we'll share about what our team is currently working on and allow you to share what you are working on with other high-income earners.
Welcome back to High Income Earners FIRE podcast. It's your host, Cody Ye. Today, Aline Prack, my co-host, is still absent, yet to be found. She's still really busy at her full-time job work, but she might pop back in as a special speaker anytime soon. But more importantly, today, we have the one and only Shane on our podcast. I was on Shane's podcast about 1.5 years ago, and he's a very established real estate developer in Calgary, Canada, on the west side of Canada. Again, our listeners are all over North America. And Shane's in-law has a very big establishment in the real estate public fund sector as well. We'll definitely touch on that, but I just want to welcome Shane today.
Thanks for having me, Cody.
Cool, Shane. So for people who doesn't know you, give us a quick synopsis of how do you get to this point?
I started in real estate, like technically in about 2003, 2004. But before that, I grew up in a smaller town, Whitecourt, Alberta. My parents were both teachers. And so I did a lot of manual labor, right? Building logging roads, construction. And I just knew at a young age that wasn't really what I wanted to do forever, right? I wanted to get an office job. I wanted to, make high six figures or even low six figures when I was 18. Just thinking about that was almost seemed unattainable. Anyway, so I moved to Calgary in about 1996, 97, went to U of C. And then in about, like I said, when I graduated in 03, I got into real estate. I couldn't get into oil and gas because that was really where I thought I was going to do well, right? But back then oil was, probably $20, $25 a barrel. Yeah. No one was hiring. And so I ended up at the city of Calgary in the assessment department. And one of my first jobs was to kind of analyze the sale of a home that happened twice in the same year. And we wanted to find out whether it was fraudulent or if it was a legitimate, like why was the house going from 250 to 100, for example, right? Mm-hmm. And that's where I started to see, okay, investors are buying these homes, they're fixing them up, and they're making as much money as I might make in 2 years. So I saw that. I asked around. I, talked to some of the other assessors. I noticed where they were building. I got my real estate license and I started to fix and flip homes, right? I mean, that was kind of how I initially got introduced to it. I mean, I joined RAIN and probably what a lot of Canadians do. They kind of go down that path and start to learn and get a little bit of mentoring. But at the end of the day, it was fixing and flipping, getting into spec homes. And you have to remember in 04, you didn't have to be that smart, really, in my opinion, to do well in real estate. The market was just kind of climbing. And so by the time I got to about 07, 08, and I was doing maybe anywhere from 10 to 15 homes a year. Flipping and, like I said, spec homes. So I was building and selling them.
What's the average profit if you flip one house at that time?
Well, I mean, when I first started, I was almost, I never wholesaled technically, but I mean, it started off at like 25,000 a home. And then you could go all the way up to, when I was doing spec homes, 200,000 or more. Right. Wow. And so I started to kind of think that I was pretty good and smart. Yeah.
So why didn't you stop there? I mean, 20K.
Well, because what happened. Yeah. I mean, in 08, right. Here's the thing I think that sometimes people don't consider. And that is, I was rolling my profits and I was starting to do bigger deals. Yeah. And then what happens is then I started to get into more speculative deals. So I invested in Costa Rica, and that, like, one project, I lost $250,000 just like that. And it was actually like that moment, because at that time I was a girl who's now my wife, but her father-in-law, who we've kind of talked about in the past, and I'm not going to mention his name. I mean, people can probably figure it out if they want to, but just to be kind of sensitive to his privacy. But he took me on a trip, and this was like probably in '08, because I remember that the financial crisis was starting, but I don't think it had really kind of like you could see that things were starting to come unwound in the US, starting to feel that credit crisis here, even in Canada. And so anyways, he took me down to the US, and it was just a very different experience in terms of how he bought properties, how he analyzed them, how he negotiated, how hard he was on people. Growing up in the environment that I did, I always wanted people to like me, right? And so I was very, I guess, just nice, and it probably came across as being naive, quite frankly. But I didn't know that, right? Because I never had a mentor. I never watched how people actually conducted themselves. And so it was never that I was shown or taught or said, you should do this or you should do that. It was just either through observation, or if I made a mistake, I was kind of, I was made aware of it very quickly, right? Mm-hmm. And so there was no book or course. It was just very much like, if you're going to do this, then you really need to step up your game. And so anyways, long story short, we ended up buying 5 homes in Palm Springs. And that was kind of the first syndication, right? We raised some money from friends and family, accredited investors. And then we did another deal and another deal. And then during that time, I was also helping their family company buy Class A apartment buildings in Texas. And so, when you start doing kind of $20 million projects, you start to see even at another level, right? So I went from, call it $200,000 to $400,000 homes to buying portfolios of homes. And now all of a sudden we're buying apartment buildings, right? Mm-hmm. And at every level, you just start to see the sophistication, the intensity. You can see that if you make a mistake on 200,000, it might only be a $20,000 mistake. But if you make if you're off by 5 or 10% on 20 million, that could be all your profit. Yeah. And so anyways, those were, that was kind of the stair stepping into how I went from, say, residential to commercial. And now, I do some of my own developments, and I'm a partner in a construction company. So we can talk about any of that stuff if you want.
That's so amazing. When I was on your podcast, it's more on my side, but now finally I can unravel a lot of that.
Yeah.
And so kind of your in-laws show you how has it been done at a higher level. Mm-hmm. You learn how to truly manage a team, not to be like, but at the same time to be fear at some point, kind of like a love and fear relationship. So they respect you. Not that you're trying
that I think that's the key word, is not feared. Maybe some people, like, they might have felt intimidated.
Some stress.
Yeah. And I think that's important and interesting how you kind of saw it that way too, because I think some people probably do fear people that are more intense or intimidating. But when you get around other business people, that, at least in my experience, it goes away. It quickly, fear doesn't come into that.
No.
A mindset. It's very much a level of respect, right? It's kind of like, this individual is kind of a hard ass negotiator. They're tough. But beyond that, it's almost like, what is the reputation? Are you fair? Do you take advantage of people? And so I learned, like, especially in commercial real estate, like, your reputation, you really have to protect it, because you end up dealing with the same people over and over. And so word gets around very quickly, right? I mean, the Calgary market, I mean, you're 1 or 2 people away from knowing everybody, if you will, right? And so maintaining and first developing your reputation and then maintaining it is very important.
Mm-hmm. Since we're talking about this reputation thing, there's a lot of new investor that comes out. And some of them, you say was a lot easier back then because we're going to up market. Truly, Canadian market was always up, except for Calgary, kind of since 2014, we have a big kind of dip and finally breaking even. And then, we're not going to, you can give me some prediction at the end where you think the Calgary market would go. Sure. But focusing more on this reputation part, a lot of new investors come out. They've been taught to just buy, even if it's high interest rate. Buy now, refinance later, even if it's a bit of cash flow negative. It's okay, but you buy a lower price, you refinance later. And a lot of them are, we buy anything and all that. So what would you say to those newer investors coming in knowing that what you know now, you try a lot of different asset class, right? We didn't even talk about you try different asset class, right? What would you say to them?
So, like, one of the things that I always start with anybody that's looking to get into investing, and this isn't investing advice, but it's just what I've witnessed and what has kind of worked for me. And that is like getting very clear on a few things, like what is your ultimate outcome? What is your risk tolerance? I mean, I used to, back when I was coaching, I would have conversations with individuals that, especially in Toronto and Vancouver, that to the market's going up like 10, 15% a year. They're buying pre-construction condos. They're telling me they're making 100% over on their money. And they're like, they want to take that same mindset and philosophy and pump it into a commercial deal. And I'm just like, well, that, like, if you find them, then you should just keep doing those. You know what I mean? Like if you believe that and you're happy with that level of risk and the long-term, like, I don't even know why you would have a conversation with me, because I clearly, I generally look for 10 to 15%. Like that's kind of the bandwidth. Now, sometimes our developments, because they are higher risk, you're probably going to get into the 20% returns in some cases. But you have to understand that as a developer, you are taking on higher levels of risk, and you should anticipate and expect that. But I think anybody that is, look, if I focused on back in 08, 09, when we were buying those Class A apartment buildings, well, they like 3x their equity in like 5 years. But you have to understand that there was a lot of things like market timing plays such a huge role. And so if you're buying at, call it a 6.5 cap, and then the market goes to a 5.5 cap or a 5 cap, like you didn't do that. The market did that. Right. Mm-hmm. And now all of a sudden, like rents go up $150 because people are getting foreclosed on, but they still need a place to live. And so you had this kind of like perfect storm, if you will. And like literally if the public company that I helped, if they would have just held it, because they sold in 2016, right? So call it 5 years is roughly, I think 5 to 6 years was roughly how long they held it. But if they would have held it for another 5 years, because the market continued to run, they probably would have 5x'd, right? Because they're buying Class A apartments at $80,000 a door. And if you think you're putting 20% down, that's like what? 15 a door. And then they're selling now for 200 a door. I mean, you can kind of quickly do the math, not to mention you're getting the cash flow, because it went from 850 a door up to probably 1,700, 2,000. I mean, the numbers are crazy. And so, anyways, so I think it's always important. Like, I never, being in Calgary and the market being flat, like I really feel this is where like true investors have to kind of make their way, right? Because I don't think it takes a lot of genius to make money in an up market. Like I wasn't being self-deprecating. It was the truth, right? I wasn't that smart in 04 to 08. I just bought and the market just carried and covered up all my mistakes. 08 hits, and then my sloppy due diligence and the way that I was doing business caught up to me very quickly, right? If you can lose $250,000 in one deal, like you can just imagine you amplify that over other deals.
So knowing that what you have seen,
right?
Due diligence.
So back to your question. Yeah.
Market timing is key. Rent goes up, save a lot of people. Even in Toronto, commercial is still quite steady. The rent still went up. So a lot of people are still making money, even though the construction went over double. They're still like, we're still okay. But for the residential side, if construction went over double, the price dropped 15 to 30%, you're in big trouble, right? So I know real estate is very localized. Calgary has been historically more flat. Toronto has been historically more volatile, but more appreciation. Well, if you have a crystal ball, like what would you tell? If I know you don't do much coaching anymore, but if you have a new coaching student right now, what would you tell them to do?
So markets do change, and I'm always reluctant to give advice, right? Because someone that's 60 is going to be different than someone that's 25 or 30 that can
take me, for example. I'm 32.
Sure. Yeah. So you're 32.
I own a handful of properties, smaller multifamily. I have a business partner that owns more than 100 unit multifamily. What should we go from here?
So what kind of returns are you looking for? What would you be happy with?
I make a lot more of my cash flow on the stock option side. For the last 9 months, we still make 1.5 to 4.5%. We don't pick stocks, but more for real estate is more generational. More we want the whole bundle of appreciation, equity pay down, and the cash flow, right? So we're not looking for something crazy. We're trying to help more people and bring more people on board, whether that's through syndication or actually looking at a fund, right? So creating a fund.
Yeah.
So this is our first one. So we want a good track record to build on. We don't need to have the biggest return, right? We're not trying to prove anything, but we try to make people know that we know what we're doing. We don't need the biggest return, right?
So, I mean, in my experience, like the easiest asset class in commercial real estate is multifamily, right? Because people need a place to live. Generally, people have invested in residential, so they understand like what a good neighborhood is versus a bad neighborhood, right? As soon as you start getting into retail, industrial, office, there's so many variables that unless you're an insider, I feel that you're really at the mercy of a lot of sophisticated commercial real estate professionals, right? Because they've been doing it and they understand why a tenant will go from this building to this building. They know where the demand is. In residential, I would say the playing field is more level. And so from that perspective, I would probably to that asset class. I think right now you're seeing that the market is probably moving into more of a buyer's market, right? Mm-hmm. So the people that I do kind of mastermind with that are across Canada and the US, when they were new to real estate, they struggled to get brokers' attention, right? And I said, well, that's because money is a commodity. And if there's 30 buyers for one property, just know that you're basically being used to pump up the price of that property. But this is the game, and just know that the pendulum will come back around to where it's a buyer's market. And so when you were getting ignored 6 months, 12 months, 18 months ago, now they're going to be calling you because you demonstrated, you didn't get upset. And this is the time that I feel that probably not right today, if you will, because real estate is slower to respond. But look, interest rates have gone up. And I think that there's probably going to be some people that unfortunately are over-levered, that have their debt coming up. They're going to have to pump in equity, and they're going to be in a situation where they may be forced to sell, right? And so I would really be looking for opportunities where probably like your B properties, where they're still good, great neighborhoods. Personally, I stay away from the poor neighborhoods. I've done it. I own one right now, and I can tell you it's just not how I want to run a business. You can do very well, but it's just a lot more effort and energy. And so for me, I just have a different philosophy in terms of what I want to create, right? I want to be able to take my kids there and like them to look at it and be proud and all the rest of it. So we stick to good neighborhoods, a little bit of value add, and, shoot for kind of that 8 to 12%. And then when the market comes back and, interest rates go back down, you might do even better. But I think the people that are trying to hit home runs on every property, generally speaking, they fizzle out, right? And I'm looking at this for 50 years, not 5 years.
Mm-hmm, mm-hmm. I know we don't mention names, but your in-law in this industry for a long time have a lot of impact on you, on how you were doing things in the beginning and how you're doing things now, combining with your own experience. Can you tell us a bit more of that?
Yeah. So Andy is his name. So they have real estate in Western Canada and the US. Okay. I can tell you that like, it's hard to compare because they have a team of 100 people plus, right? So they have people that can oversee, travel, and manage. I've done that. I mean, I used to own one of the first properties we bought was in Muskoka. It was a 1,100 acre, 2 resorts up in Bracebridge and or just outside Bracebridge and Gravenhurst. And so I know what it's like to have to travel. And anytime I'm just going to use the word a foreigner, like you're not from there, mm-hmm. You learn some expensive lessons. Right? Mm-hmm. Like, hey, who can you even trust? Right. And so I've created just principles that I use and follow right now. And that is, I try to invest as close to home as possible where I have a competitive advantage. Mm-hmm. Right. So even thinking about your own industry, right? Like if I tried to do what you did without your guidance, like I'm the dumb money at the table, right? Like, I mean, I just played blackjack for the first time in 5 years. And literally in 5 hands, I went from like whatever, it was like a couple $100, like down to my last bet, right? And then my buddy who plays every once in a while, he's like, hey, just listen to me. I'm like, okay, because I mean, I have nothing to lose at this point, right? So I listened to him, and then over the next hour, we had fun, and I ended up cashing out and making a little bit of money, right? And so I think it's a good example of like, if you're sitting at the table, and I just looked around, and I'm like, I'm obviously dumb money at the table, right? Yeah. And the difference though is in the world of commercial real estate, you don't know what you don't know for most people, right? And even as a developer, sometimes you're walking into a deal and you don't fully understand, like, what are the services? What are the offsite levies? What are the unknowns? What are the things that are going to really hurt me? And I'm talking about like billion-dollar companies that make mistakes and lose tens of millions of dollars because of something that they, like they might have done geotech, like drilling holes, but they didn't drill. Like most often, they're not going to drill every 20 feet, right? Yeah. And so if they didn't drill in a certain area and they find something that was unexpected, all of a sudden that could throw your pro forma off, right?
Yeah. So stage 2 and all that. Yeah.
Yeah. So I guess like to kind of bring this all back, I think just having really sound investing principles, right? And investing in what you understand. I've done retail, I've done industrial, I've done mobile homes, I've done second mortgages, spec homes, land development. And what I've realized is, had I just stuck to one asset class back in '08 instead of like jumping all around, I would be 10 times further ahead, right? So anybody now, if you're a passive investor, that's different, right? You can pick the horse, like pick the person you're going to invest with, and the operator, and find people that have a track record and that are successful. And generally speaking, the people that are the most successful are not having to market to find investors, right? So a good example of this, I can't say their name just because a lot of this stuff just people tell me in confidence, right? Yeah. But there's a group out of Winnipeg that I know, and they might have, I don't know, in the billions, right? And so every time they have a new project, they send it an email to their list, and it fills up in, I think he said the last time was 30 minutes, and they raised over $30 million, right? And it's not because they use a sense of urgency or anything like that. It's just they have a track record of 40 years of paying very good returns. And they basically just say, here's the deal. It's not hypey. It's not salesy. Like I see one of the things that I learned, and I'm just kind of rambling, but you just tell me when you want me to kind of get back on track. But
keep rambling. I'll stop you if you're rambling. Yeah. It's not good anymore. It's good rambling. Keep going.
Like when we would go out and raise money for our own deals, I used to, like, the first couple of pitch decks or investor presentations that I put together were more salesy, in the sense that I was using fluffy language, and Andy would just say, like, get rid of all that crap. Like we're like focused on numbers. Like we can tell the story, but you don't need to be hypey. And so when I see investor presentations that use a lot of like fluffy language, and it tells me more about the individuals that are behind the deal versus like when I see investor presentations that are put together by sophisticated people that have been in the business for, call it 20, 30, 40 years. They're not trying to oversell. If anything, they're being more conservative because they know that they would rather come under and then come up here. Deliver. Yeah. Versus sell way up here. And because even if you come right underneath it, in terms of the return expectations, people are saying, well, hey, you said 25%, you're only at 22. Like what gives, right? Mm-hmm. Whereas if you just said, look, you could probably sell it at 18. If you hit 22, your investors are going to be like, hey, they did more than what they said they were going to. Right. And I've never had someone say that they were unhappy with me exceeding expectations, but the inverse is definitely true.
Yeah, definitely. That's a lot of great value, in case people don't realize that. We spent quite some time on a bit of what you learn from, you say, Andy, from the business practice, how actual high achievers, who actually people has a track record with a public company and funds and all that. And you talk about how you kind of do your own stuff. If you could have stuck to one thing, I remember you told me you would have a bigger office. Not that you need it or want it, but you would have a bigger office. People get what that means. Is there any other, because our podcast is called a High Income Earners Fire Podcast, right? A lot of people might be, limited partner, just want to be a passive investor, or they might have a high income, but they still want to use real estate actively to get out of their rat race. What are some of the worst moment you have seen in this industry? The worst moment where you experience yourself where?
Yeah, like I've seen, I remember, I've told the story, I think, in the past, but so my wife is an interior designer, right? And so she used to kind of help me when I first started doing my residential flips. And she had these two clients. One was a dentist, one was a pretty, successful residential investor. Anyways, these two guys came together. They raised about $6 million. They bought, from my opinion, like a pretty crappy property. Nothing wrong with that if you have a plan and you can execute on it. But by my own estimation, they overpaid because I know this because about 7 years later, I'm sitting in the office of the guy who's telling me the story from his perspective, the guy that bought it for 10 million, sold it to these two guys for 16 million, took a VTB, and then ended up owning it in 18 months because these two individuals, unfortunately, didn't know what they were doing, right? And they got probably in over their head, and lots of different things probably happened. But at the end of the day, they lost $6 million, right? Of not just their money, but their investors' money. And I've seen individuals in their 70s that go into a development and they chase a deal all the way to the bottom, meaning it's almost like you have so much invested and you have this bias. I can't remember what cognitive bias it is, but it's like this sunk loss fallacy,
sunk
right?
cost.
Like,
just can't walk away because I put in so much, and people
I can't be wrong.
I can't. It's like you already make the decision. Now you're using a rationale to back everything up.
Yeah.
Right?
Yeah. And like there's a guy that was worth multiple seven figures and ends up losing everything and, his family. And you see these stories, and I just have really tried to be aware of it. Number one, not go in over levered on any deals. And I think one thing I was going to mention, and knowing kind of your audience being more kind of passive investors, I think one of the mistakes I made was going all in on commercial real estate too soon. Yes, I had some money that I could kind of afford, and I was also in my 20s. So for me, I didn't have a family to look after, right? I could because I didn't make money. I wasn't paid for 18 months. It wasn't until we did our first deal that I actually made some money. And I think oftentimes people are sold on this idea, this concept that you're going to do one commercial real estate deal and it's going to pay you, and it might, right? It might, if you're happy with making 8% on it and you have $2 million to put in and you buy in the right place. But more times than not, I see, unfortunately, people buying the wrong properties. They hold on to it for 2 or 3 years. They mismanage it because they don't really know how to manage it. And then someone else that comes in that has experience, that is more well capitalized, comes in, buys it for a song, fixes it up properly, and they're the ones that actually make money. So there's kind of a joke that it's usually the second or third person that buys the property that makes the money. It's not always the first one. So I'm not saying this to be mean. I just, I think if you're a passive investor and you're better at making money in your profession, then spend a bit of time and find people that you can trust that do have that track record, and invest alongside and learn as you're kind of going, but with limited risk, because your risk is only going to be the money that you put into the deal as long as you're a true passive investor, right? Yep. Let the developers take on the risk that are guaranteeing these loans, right? Like, I mean, I've got, I don't know, probably $40 million guaranteed right now. And that's, that's that would make a lot of people uneasy.
So
but
what does that mean? $40 million guarantee. What does that mean? Explain it to us.
Yeah, it just means the number of projects that we have out there, right? So on one, for example, is an $18 million loan. That's just one property, right? But if you do, we have 5 right now. So 40 might be too high because we just sold one. So that relieved about $9 million of, but whatever that number is.
That's
right?
where you as a GP or as a builder that you have to build on that project. Which one?
As an individual. So
like that's your project. You're personally guaranteeing that 40 million.
Correct. Unless you have a company that is substantial enough that can guarantee it, but that's not for very many people. So
yeah, even a lot of people find other guarantors too.
That's right. Yeah. And just so you know, like I'm not the only one, right? Yeah. Like there's, but I'm just saying my guarantee is on all these properties in combination. So yeah. And then you have your partners that come in, your other general partners that come in and help guarantee these. But so that might sound very risky to someone, right? But if you have enough equity and you know what your cash flow is going to be and you can execute on projects, I mean, that might sound like a lot to some people, but I know people that are doing, one project might be $500 million, right?
Yeah. You don't go from 0 to 100 really quick, but you keep climbing that ladder, right? Mm-hmm. And everything you do right now or along the way is building to the next step. So people don't go from 0 to 100, but everything you do, there's a reason for it. But you keep pushing yourself a little bit until you get to the point you look back. People that are chasing you might be like, holy cow, what you're doing is really risky. But you look at the people up there that they're doing really risky stuff, but it's all relative, right? Based on your knowledge and experience.
Yeah. And I guess, and just to kind of piggyback off that a second, like I'm actually not looking at other people in the industry because I think that that's a good way to overextend yourself and start to move too quickly. It's like I did when I was starting out, because I would see other people thinking like, how are they so much further ahead? And then it would cause me to make poor investing decisions, right? Now it's more just like, look, here's our goal for next year. Here's our goal for the year after that. Like we kind of are planning out maybe just 2 years right now. And it's like growing at a pace that we know we can execute at, and we'll start to ramp it up, possibly. But at the same time, markets always change too, right? And so if the market is telling us that we shouldn't be scaling and that we just have to button down, then that's what we'll do. So it's, nothing happens in a vacuum.
Definitely. Great combo. Before I go into our final round, fire round, I give you 5 quick questions. Remember in the beginning, we talked about your crystal ball. So can you touch your crystal ball and tell us what does your crystal ball say to you in the next, let's say 6 months, 12 months, or what do you think real estate, this part of things is going to happen?
Sure. Like, obviously I'm biased, right? So anybody listening, just understand that I invest in real estate. So I'm more biased to me making money.
Everyone wants to go up. Everyone wants to go up. Yeah. We know that, but
at the same time, it's like, I might be, okay. So like the next 12 months, I think the market will probably have more, turmoil, and I think there will be more defaults, right? I generally look to the US because in my experience, it usually happens faster in the US. And then Canada seems to be a little bit slower to respond. So I'm just kind of watching what's happening on real estate values down there. I'm already seeing builders pulling back big time. So I think I'm hopeful anyways that there'll be some more buying opportunities over the next 12 to 18 months, right? And that's what, generally speaking, a lot of the smarter people than me are telling me what they're kind of looking at. So, but who knows, right? Does that mean that I'm not going to, like, we're looking to make an offer next week on something and it would be one of the biggest deals, because I'm not looking at it, like I said, in the next 12 months, I'm looking at this project for the next 10 years, right? So as long as the numbers still make sense today, they're going to make sense in 10 years because it's going to go up and down. I already know that. I think longer term, I think interest rates will come back down. I don't think they'll ever go as low as they were, but I feel that right now, there's a lot of people that I think are getting squeezed hard, right? If you have any type of variable debt right now, and it's gone from 2% or 3% up to 6 or 7%, I mean, that is very, like, that hurts, right? Yeah. It's painful. And it's one of the other reasons why I'm not as big of a fan on commercial. And at this point, when I say commercial, what I mean by that is like industrial, retail, office. And the reason for that is, and I've got 2 retail developments right now. And that is, you generally are setting your rates on day one, and you don't have the flexibility like residential, where like we start building and we thought rents were going to be $2,000 a month and they go to $2,400 a month. Well, interest rates go up. So on scale, it balances. But if you lock in your retail tenant at $30 a square foot on day one, and then it takes 12 months to break, to actually deliver them a property, well, your construction financing, and then you have to go to your takeout debt. And I guess my perspective is more as a developer, that is just a very challenging place to be in, right? Because you thought your debt was going to be 3.5% or 4.5%, and now it's at 6.5%. So
yeah, that can significant. Well, thanks for a crystal ball. Now we're going to go quickly into our fire round.
Sure.
And we're going to keep it fun. So the first question for our fire round is, if you become a billionaire with the B, if you're not yet already, what will your day look like?
That's kind of hard to imagine, if you will. So I'm very far from being a billionaire. And I don't know, like, I think if I was to daydream and say that was a reality, I'd probably have a place in, like, my wife and I have talked about this. We'd probably have a place on the water in Kelowna to be able to water ski with the kids every morning, take them to school. I'd probably do business like I'm doing. Like, I love doing what I'm doing, so I wouldn't change that. I would continue to do that, especially because I'm in my 40s. I don't think playing golf every day would be enough stimulus for me. So, but I would like to be able to know that I can bugger off and go play 9 holes or 18, pick up my kids from school, take them to soccer. I don't know. I have a pretty simple, my life right now is pretty wonderful. So I'm not, probably not that far off, but maybe just having a nicer boat would be the first thing I'd get.
Okay. Second question. If you lose everything, I know you personally guaranteeing on 40 million, not just yourself, with a lot of, I hope that never happened with your experience or the in-laws experience backing you. This never happened. But that's just say something hit the fan and all of a sudden you lose everything, but you still have all your knowledge and reputation. We drop you of $500,000. What would you do right now to start over?
But I had $500,000?
Yeah, we drop you $500,000, like parachuting. The in-law giving you like, Shane, here you go. Start over.
I think if I have my same connections, I would continue to I'd probably do smaller infill residential developments. Just because I know that I can do them, I can bang them out, and I wouldn't need much more than $500,000 plus or minus. And I know how to raise money, so I could do that as well. And secondly, and one of the things that I would probably really double down on is just growing a business, right? Because that business is going to give you the cash flow to be able to take and invest into these deals. I think one thing I've learned is commercial real estate, whatever you get into, it takes a while, right? 12, 24. Yeah. Like I've had projects that have taken 4 years that were supposed to take 2 years, right? Because COVID hits and everything all your plans get thrown out. So I'd probably start on those smaller infill projects for rent using CMHC. And then I would probably just double down on our construction business and get our clients back, and assuming that they all went away, and grow the cash flow there.
Got it. Next question is, if you're a podcast host, again, Shane does have a podcast. What's your podcast name again?
It's called The Investing Advantage.
Investing Advantage. Go follow, go listen to Shane's podcast. If you can interview anyone, alive or deceased, who would you actually want to interview?
Well, that's a good question. Okay, so there's kind of 2 people that come to mind. Arnold Schwarzenegger. I've listened to his autobiography, and he was kind of like a hero for me, because I used to kind of bodybuild, if you will, when I was younger. Yeah. So I'd probably want to interview Arnold because I think he's just he's such a character. Mm-hmm. And the other gentleman that would be really interesting is Ray Dalio. I really like the way that he thinks. I mean, his books are just, incredible, very deep thinker. So I would say those are the two people that kind of come to mind.
Ray Dalio has a newest book called Principles for Dealing with Changing World Order. I listened to it twice already.
Yeah.
Again, you don't have to agree with everything, but hey, he sees a lot of things that we don't see. So before you criticize,
Yeah, of course.
Listen to it first. Yeah. It's a great book. Okay. Next question is, what are ways are you giving back? I know you have a simple life, but.
Mm-hmm. Yeah, well, it's interesting. So we just actually donated our piano. Like this is just like literally top of mind, and that's why I'm not sure if you heard my dog barking, but my mother-in-law came to pick it up, and so she's very integrated into the Calgary community and always looking for ways to kind of give back. So anyways, my wife was at a recent presentation where they were talking about a couple of boys that I don't think they have a father, and their mother, she's kind of in and out of rehab. And anyways, long story short, these two boys are very good at playing piano, but they don't have one, right? Because they are, they're just in a tough situation. So my wife's like, well, why don't we donate the one that we have that our kids use kind of sporadically? Mm-hmm. And so that's just one way, right? But I mean, obviously, like, giving money to different charities, but I think, giving some time, even though right now that's harder for me, into different organizations, whether it's the YMCA, junior achievers. Those are kind of like, I don't know, like kids to me is kind of where I feel that I want to have the most impact. Because to me, that like it's very much luck, whether or not you are born into a family that can provide, or you're born into a situation where you don't have very much. And kids, unfortunately, they don't have any choice in that, right? So anyways, that's kind of where my focus is.
I said that to my mom once, and she was so angry at me.
Why?
I said, no, I told her, because, I grew up in a broken family, but I told her, hey, just remember that you had a choice. I didn't have one. Mm-hmm. Okay. So she was angry. Anyway, that just, what we get as a business owner, no matter where you are, if you're resourceful enough, if you have enough drive, you will figure it out. It's just a matter of time.
Yeah.
If you're ready, the opportunity come, you will be the person to grab it. So really thanks for you to coming on our podcast. And before I let you go, the last question is, where can our audience find more about you? And I know you have a construction company, you have a podcast, and, sometimes you do raise capital to do your development stuff, right? So where do people find you?
Yeah. I mean, my website, just my name, Shane Melanson, MELANSON.com. Mm-hmm. There's links to my book and my podcast and all that kind of stuff on it. So that's the easiest place.
Well, thanks again. We'll put it in the description. Thank you.
Thanks, Cody.
All the links mentioned in this episode are included in the show notes. And if you love this episode, please leave us a rating and review on Apple iTunes. The link is also included in the show notes. And we would really appreciate your help in spreading the word to more high income earners on how they too can maximize both their time and money.
Also, if you still haven't joined our High Income Earners Facebook group, you are missing out on High Income Earners community, where we help each other reach our own version of FIRE.